Hi, good morning again, and welcome once more to those who just joined us. This is the Saxo's weekly market outlook call, or the Saxo Spotlight, as we call it. I'm Charu Chanana. I'm a market strategist with Saxo's Singapore office, and I'm joined today by my colleague Jessica Amir. She's from the Sydney office. So I think today we also have some slides to share. I actually just shared my slides. I don't know if you can see them yet.
Not yet.
Okay.
There
I
you go.
guess. Okay, great. Sounds good. So yeah, let's just start with last week. So I think it was a pretty pivotal week where we saw a significant rhetoric shift. So far since the start of the year, we've been talking about how a soft landing scenario is gaining traction compared to all the recession calls that were picking up late last year. But now we rather have a case building up for a reacceleration of growth, and that for now is sending some shock waves to the markets, which had started to expect pivots and U-turns from many central banks. But a reacceleration of growth could also mean that inflation could again come back, and we have seen a little bit, like I was saying, a rhetoric shift from central banks as well last week compared to the prior week, the first week of February, when we had the Bank of Canada signaling a pause. The ECB and the Bank of England were also being a little bit more dovish compared to expectations. Compare that to last week, where partly obviously there was some lingering impacts from that bumper January jobs report that we had in the US, but we also had Fed speakers turning marginally hawkish. Although I would say rightly so, that 1 month of data is not really enough to change anything, so they can't completely rely on what the jobs data was saying. But if you do look at the next slide here, we do have Fed expectations being repriced higher a notch this past week, and yields have been surging in the US, but more broadly, globally as well, in Europe as well. So, we've had a bunch of hawkish surprises last week. For example, the Reserve Bank of Australia, which raised rates, also guiding for more rate hikes, and they raised their inflation wage forecast for the year. So, kind of still trying to, stay quite alert about those inflationary pressures. Then we had a massive hawkish surprise from the Riksbank as well, and then some emerging market central bank like the Reserve Bank of India, Bank ICSO, the Mexican central bank also. They were all expected to actually hike one last time, but they're still guiding for more rate hikes. So overall, there's been this sentiment shift in the market that disinflation is actually proving to be slower than expected, and inflation will probably take longer to get in control. Well, that brings on watch, very importantly, the US CPI this week. But before we touch upon that, maybe Jess, you want to have, also what's your take on what's been happening in the markets last week?
Thanks, Charu. So I think the important thing to note is what's actually happened is US equities saw the biggest drop last week, and we've got to think about why that is. So on the back of what Charu's just centered upon, is that the market is now essentially pricing in the rates can stay high for longer. So what we're saying is we're just a little bit cautionary, and this is why we're seeing investors act cautionary as well. So the thing that we're looking at is two key risk measures. So the 10-year US bond yield, also the US dollar index, the DXY, they've both risen up markedly, and this is why we're seeing investors I guess, trim profits. So if we have a look at our equity baskets, you can see that that gains last week were trimmed quite considerably, while so far, if we think about who's still holding up the most this year, and we've seen that defence and commodities year to date, or year on year rather, I should say, are still holding up considerably, despite a bit of a choppy start to the year. But if we think about year to date, who's garnering the most returns, and it's those companies in energy storage and e-commerce. So I guess ahead of our CPI, there is a lot of risk. So that's why we're seeing investors trim profits in the US, and then also in equities across Asia, and then further down south in Australia. We're seeing that our market is also being pressured as well, because our 10-year bond yield is actually at one of its highest levels since January as well. So you've got all these key factors that are flagging essentially that there is caution, that there is risk of a potential pullback, and the technical indicators are also backing that up. We could see a potential pullback here. However, that being said, if you think about the ASX 200, the technical indicators, as you would see by Kim's update that he put on our website last week, there is room for a pullback before the market potentially heads to higher levels. That being said, this week you can see, if you can see the what we're watching, there's a lot of catalysts actually on tap this week for markets. Obviously, CPI, as Charu said, but a big thing is actually happening in the lithium space. So Albemarle, the world's biggest lithium company, does report earnings on the 16th. This will be really important as a gauge for what we can expect in the lithium sector this year. And we know, as per our quarterly outlook released, you would see that we are significantly bullish on lithium, copper, and aluminium, the key three metals that are needed for the green transformation. So watching Albemarle, but also importantly on the consumer side, we'll be watching Coca-Cola's earnings tomorrow. And also on the lithium side, or outside of the lithium side, staying on battery metals, we're watching South32, who's the BHP spin-off. So there is lots of catalysts on tap this week, but overall, we're very, I guess, bullish on the green theme. And I think what also supports this is that Ford and Cattle, CATL, are actually reportedly going to build a mega factory in the US. And what we're also seeing, and this slide is in Danish, but it essentially shows us the red line and the blue line are basically imports into the US of lithium and imports into China of lithium. And they've both skyrocketed markedly this year. And so what we're saying is, again, going back to our quarterly significantly bullish outlook on the lithium sector, we think that prices should be underpinned to the upside, not only because demand is picking up, but we're seeing also gigafactories or mega factories being built, and that would significantly underpin support for potential further price pressure. So there's lots happening in markets last week and over the last 2 days that's transferring into what we can expect not only this week, but over the medium to longer term, Charu.
Yeah, absolutely. Very important to watch these key commodity lithium EV battery metal players. I think how the report will obviously shape the industry in the next few months to years. And the other, of course, from a macro perspective, the most important thing to watch, like I said, US CPI. And while investors do firmly believe that inflation is on a downward trajectory, these month-on-month variations are still important to watch. More importantly, this month is extremely key because it brings a change in methodology. Now, I don't know if it's going to be revised higher or revised lower because of the change in methodology, but on Friday, the BLS actually released last 3 months of data based on that new methodology, and all of that, the last 3 months of data, has been revised higher. So there is some expectation picking up that we could see a bump higher in inflation prints because of this new methodology as well. And overall, of course, if you consider that January was a much milder weather compared to December, so people obviously went out, there were demand pressures. And there was, obviously, from the jobs report we've seen, there was an upward swing in job numbers as well. So I think even that potentially kept demand pressures pretty high compared to what we saw in December. So there is enough reason to believe, although the consensus expectations are looking at a somewhat softer softer headline print of 6.2% year on year, uh, we should, I think, brace ourselves for an upside surprise here as well. In the FX space, I think the Japanese yen is certainly one important currency to watch. At the end of last week, we were given a surprise where BOJ, the Japanese PM Kishida, he actually announced the nomination of a dark horse candidate, Kazuo Ueda, as the next governor for the Bank of Japan after Kuroda steps down in April. Now this is a name which really wasn't, being considered. We had a lot of names floating around over the last few weeks. Amamiya, one of the ex-deputy chiefs of the Bank of Japan, was being considered a front runner, and he's relatively more dovish. But if you dig into Ueda's past research and his prior speeches, it is revealing that he is a little bit of a more he has a little bit of a more of a neutral stance, obviously compared to Amamiya. But there were speeches around that Japan should not tighten too fast, but there were also some questions in some research where he talked about whether the Fed has been too slow to raise rates. While I think it will be a bit aggressive to start expecting an outright removal of the yield curve control policy, but I think those expectations of tweaks in BOJ's ultra easy monetary policy are not going to go away, because he's certainly a little bit more hawkish, I would say neutral, compared to the first candidate that we saw, Amamiya. So I think that is something that will obviously keep the volatility in the yen pretty high this week. But again, what we discussed earlier, US yields are rising, so that plays a big part in terms of the performance of the Japanese yen as well. And on top of it, now we have the oil prices surging as well because of Russia's production cut, which we'll get to in a few minutes again. But again, Japan's inflation continues to be a problem as well. I think the other key currency to watch this week will be sterling. Lots of key data is due. We have the labor market data coming out on Tuesday, the CPI on Wednesday, and retail sales on Friday as well. And with the Bank of England kind of signaling pause after their previous rate hike of 50 basis points in the first week of February, I think these in high frequency data will really be key to watch. Inflation is still likely to be stuck in the double digits, 10% plus kind of levels. Labor market's still quite tight, and we had a bumper labor market report from Canada as well. So it kind of again gives us a signal that January jobs numbers are globally looking quite upbeat. So let's see what we get from the UK. But I think there is potential that the expectations of a March rate hike could pick up as well. I mean, market is already pricing a 25 basis rate hike for March from the Bank of England with a 90% probability. So I think the scope for strength in sterling is still limited. But if we do see that going considerably above 25 basis points, tilting more towards a 50 basis points rate hike, maybe you could see some sterling strength coming back as well. And I think maybe Jess, do you want to take it from here on what to watch in commodities?
Yeah, thanks, Charu. I think just going back to the high US dollar, with the DXY, the US dollar index, up and closing at its highest level since January, we just have to be aware, and investors need to also be cognizant or keep in center of mind that a high US dollar is actually pressuring commodity prices down. So that is why we're seeing oil, I guess, essentially a proxy for global growth, and a copper trading quite volatile. If you think about copper, though, are also a proxy for global growth and crucially important to Australia's share market. The copper price has trended lower for 3 weeks now. And so if we do get a hotter than expected inflationary read, so I guess the underlying number that the market is looking for is a shift down from 5.7%, correct me if I'm wrong, 5.7% to 5.5%. If we don't see that, then there is a real risk that the US dollar could run higher, and then that could essentially, again, pressure commodities down. So the key catalyst here is of course, the US dollar. That's what we're always watching in this space. That being said, we do hear from one of the largest uh, pure play iron ore companies in Australia this week. So Fortescue Metals, their results will be reported on the 15th. We do know that the iron ore price is up about 70% from its lows. So we are expecting bumper profits and potentially a record profit and maybe also a record dividend. That being said, there is some price pressure coming in across broad commodities because of the high US dollar. But again, going back to our long-term bullish picture, we are quite bullish on industrial metals. And for more, you can refer to our quarterly outlook. And secondly, we put out a piece of 5 stocks to watch this week that you can refer to as well. And lastly, just refer to Saxo's green transformation basket and our lithium basket. And you can get a list of all the stocks that are in these key sectors that we are watching and where we believe there's likely the most upside ahead. Charu, back to you.
Yeah, as you just mentioned, Jessica, I think it's just important to highlight that we launched our quarterly outlook last week, and it is titled "The Models Are Broken." So we talk about several models here, such as globalization model, or even the digitization model, energy and food supply models, and many more. So I think. Just a very nice read and a very intriguing read, and you will obviously be able to understand what it means for the markets as well when it cannot really go back to those old models. So please access those articles if you want to on our platform or on the website. I think it's a collection of 10 or plus articles, so I think a big read there coming your way. But I think that's it from us here at Saxo today. Have a good day, good week, everyone.